Introduction to Financial Services, Consumer Finance. Updated January 4, 2021. Consumer finance refers to the borrowing and saving choices that people, that is, households, make over time. These financial decisions can be complex and can affect financial well-being both now and in the future. Understanding why and how consumers make financial decisions is important when considering policy issues in consumer financial markets. Research on household finance suggests that all of the components of a household's finances, income, consumption, savings, assets, and debts, are important to understand a household's financial experience over time. Safe and affordable financial services are an important tool for most Americans to achieve financial security over the course of their lives. People use three types of financial products: credit, insurance, and financial investments. This CRS product focuses on the first category: credit products, loans for household purposes. Consumer debt. Households typically borrow money for the following reasons: asset building. Using credit to make investments can allow a household to build wealth over time, for example, a mortgage or student loan. Consumption smoothing. Using credit to buy and consume now and pay later, for example, a credit card. Financial shocks or emergencies. Using credit to pay for unexpected expenses, such as a car or home repair, a medical expense, or a pay cut, for example, a payday loan. Most households rely on credit to finance some expenses, either to avoid having to postpone consumption until sufficient funds have been saved or to avoid having to liquidate wealth that is being accumulated for other purposes, such as retirement. According to the Federal Reserve Bank of New York, mortgage debt is by far the largest type of debt for households, accounting for approximately 69% of household debt. Student debt, 10.8%, is the second largest household debt, followed by auto loans, 9.5%, and credit cards, 5.6%. As of the second quarter of 2020, household debt totaled $14.35 trillion. See Figure 1 for more information on household debt as of the third quarter of 2020. Figure 1. Household debt breakdown in Q3 2020. Consumer lending regulation. In economic theory, consumer lending markets that are competitive should lead to efficient outcomes for consumers. Yet, sometimes, market inefficiencies may be observed. Common issues in consumer financial markets include 1. Information asymmetries between financial firms and consumers, and 2. Behavioral biases that predictably bias consumers when making financial decisions. In these cases, government policy can potentially bring the market to a more efficient outcome. Policymakers still must monitor the benefits and costs of various regulatory approaches to determine whether a policy intervention will help or harm the market. Although each consumer financial market is governed by various distinct laws and regulations, three types of policy interventions are common. Standardizing consumer disclosures. Financial products can be complex and difficult for consumers to fully understand. Mandated consumer disclosures are generally intended to give consumers more information about the costs and terms before they take out a new financial product, thus reducing information gaps in understanding. Standardized disclosures also can help consumers shop for the best terms, because all financial product terms are required to be disclosed in the same way, preventing unfair, deceptive, or abusive practices or acts. Consumers seeking loans or financial services could be vulnerable, because some consumers may lack financial knowledge or be susceptible to behavioral biases. For this reason, certain consumer protection laws prohibit unfair, deceptive, or abusive acts or practices. These acts and practices can include both individual firm conduct and product features, ensuring fair lending. Fair lending laws prohibit discrimination in credit transactions based upon certain borrower characteristics, such as sex, race, religion, and age. These laws historically have been interpreted to prohibit discrimination, whether intentional or due to disparate impact, in which a facially neutral business decision has a discriminatory effect on a protected class. Consumer Financial Protection Bureau. The 2010 Dodd-Frank Wall Street Reform and Consumer Protection Act, PL 111-203, established the Consumer Financial Protection Bureau, CFPB, to implement and enforce federal consumer financial law while ensuring markets for consumer financial services and products are fair, transparent, and competitive. The CFPB generally has regulatory authority over providers of an array of consumer financial products and services, including deposit taking, mortgages, credit cards and other extensions of credit, loan servicing, consumer reporting, data collection, and debt collection associated with consumer financial products. The CFPB's authorities fall into three broad categories: rulemaking, writing regulations to implement laws under the CFPB's jurisdiction; supervision, the power to examine and impose reporting requirements on financial institutions; and enforcement of various consumer protection laws and regulations. The Act also directed the CFPB to develop and implement financial education initiatives, collect consumer complaints, and conduct consumer finance research. Selected policy issues. This section highlights selected policy issues of congressional interest relating to consumer finance. The economic impacts on consumers of the COVID-19 pandemic. Since March 2020, the economic impacts of the coronavirus disease 2019 COVID-19 pandemic have caused many Americans to lose income and face financial hardship. Survey results suggest that since March 2020, half of all U.S. adults live in a household that has lost some employment income. As a result, many consumers have had trouble paying their loans. Loan forbearance has become a common form of consumer relief during the COVID-19 pandemic. Loan forbearance plans are agreements that allow borrowers to reduce or suspend payments for a short period of time, providing extended time for consumers to become current on their payments. These plans do not forgive unpaid loan payments. The CARES Act (PL 116-136) established consumer rights to be granted forbearance for many types of mortgages, Section 4022, and for most federal student loans, Section 3513. Moreover, financial regulatory agencies responded to the COVID-19 pandemic using existing authorities to encourage loan forbearance and other financial relief options for affected consumers. Although these efforts have prevented many consumers from falling delinquent so far, it is difficult to predict the trajectory of future COVID-19 outbreaks and their subsequent impacts on consumer credit markets. CFPB regulation and structure. In the decade since the CFPB was created, it has been actively engaged in many rulemakings. Policy debates concern whether the CFPB has appropriately balanced protecting consumers, credit access, and costs to industry. Significant and contentious CFPB rulemakings have regulated the payday lending and small dollar credit market, the mortgage market, and the debt collection market. In addition, the CFPB's structure and budget continue to be debated by Congress. Credit reporting. The credit reporting agencies, also called credit bureaus, collect and subsequently provide information to firms about the behavior of consumers when they participate in various financial transactions. Firms use consumer information to screen for consumer risks. For example, lenders rely upon credit reports and scores to determine the likelihood that prospective borrowers will repay their loans. Various policy issues related to credit reporting include how to address inaccurate or disputed consumer information, how to ensure consumers are aware of their rights, such as the right to dispute inaccurate information, and what information is fair to include in consumer credit reports, for example, whether medical debt or new types of consumer data should be included. Financial technology. Financial technology, or fintech, refers to financial innovations that apply new technologies to a financial service or product. Related policy questions include whether the current regulatory framework appropriately fosters technological benefits while mitigating potential risks to consumer. The CFPB has launched several programs designed to reduce regulatory uncertainty for fintech products, facilitate industry and stakeholder coordination, and learn more about fintech services and products through research projects. CRS Resources. CRS Report R45813, an overview of consumer finance and policy issues. CRS in Focus IF 10031, Introduction to Financial Services. The Consumer Financial Protection Bureau, CFPB. CRS Report R46356, COVID-19. Consumer Loan Forbearance and Other Relief Options. CRS Report R46578, COVID-19. Household Debt During the Pandemic. CRS Insight IN 11359, COVID-19. Financial Relief and Assistance Resources for Consumers. CRS Insight IN 11059, CFPB finalizes new payday lending rule, reversing prior regulation. CRS Report R44868 Short-Term, Small Dollar Lending, Policy Issues and Implications. CRS Report R46477, The Debt Collection Market and Selected Policy Issues. CRS Report R44125, Consumer Credit Reporting, Credit Bureaus, Credit Scoring, and Related Policy Issues. CRS Report R46332, FinTech, Overview of Innovative Financial Technology and Selected Policy Issues. Cheryl R. Cooper, Analyst in Financial Economics. I.